Last week ended with the shocking news that the former Prime Minister of Japan, Shinzo Abe, had been shot and later died in hospital. He had served as the Prime Minister for Japan for almost 10 years, ending in 2020, making him the longest ever serving Prime Minister of Japan. And he became quite famous on a global basis because of some of his economic policies, which were referred to as Abenomics. I'm joined by Baylee today. I want to take a step back in time and talk through the economic landscape in Japan. I think it's fascinating. I want to talk about both the equity market and the bond market. Let's start off with fixed income and bonds. Japan have had zero interest rates for about 30 years now. Why?
Well, over that period, there's been predominantly low growth and low inflation, which has led to low interest rates. For example, pre-1990, the economy had an average growth rate of 4%. Since then, it's been less than 1%, and inflation is at less than 0.5%. What's interesting is that you can actually break that period down into 3 stages. You had the financial crisis in the 1990s, mild deflation in the 2000s, and then the fight against Japan's aging demographics over the past 10 years.
Yeah, I mean, the aging demographics is fascinating. I read an article recently said that the average age in Japan is 48. When you compare that to other developed markets like the UK, Ireland, or even the US, it's about 10 years older on average, which is absolutely incredible. And that obviously gives a lot of strain to the economy. Okay, so that's a very clear explanation as to why rates have remained low. Turning to equity markets. Now, I remember reading about the huge property boom in Japan, the huge equity market exuberance, and how strong it was in the late 80s. It was almost dominating global stock markets at the time, but it didn't end so well. So can we take a step back, explain what happened and where we're at today?
Sure. Well, the story might sound a bit familiar to you. The stock market and the property market were booming. There was a lot of loose lending. And as we saw in the global financial crisis, that level of optimism doesn't last forever. When it subsides, it can be quite painful for the economy and can be particularly painful for the banking sector, which we saw. The Bank of Japan eventually cut interest rates after different rounds of fiscal stimulus, and they've stayed there ever since. And that's due to the deflation and the demographics, as we previously mentioned. During that time, though, it became quite clear that the public no longer expected prices or wages to go up. And no matter what the central bank did, their expectations were self-fulfilling. And unlike the period post the global financial crisis, we didn't see that kind of recovery. In that environment, it's really difficult for innovation to thrive. And we've seen more tech companies prosper in the US rather than those big companies that we had seen dominating Japan in the late 80s. But on a slightly more optimistic note, Abenomics was introduced, which gave some signs of improvement. But the fundamentals of low interest rates and inflation, they were essentially unchanged. They still remained low.
Okay, I mean, like the equity market is fascinating. I know from looking at charts that we're still not back to the levels that we were at back in the late 80s, which is quite incredible 30 years later. And speaking of which, Betty, I mean, this has been a really difficult area for fund managers like yourself. In the past, I've heard countless stories of people who've tried to make money in Japan in various different types of trades, whether it's in the equity market or the bond market. It's become referred to as the widowmaker, in that it's quite hard. There's been lots of positions that have been taken, particularly on the fixed income side, which haven't been fruitful. So maybe to finish up, do you have, or did the team have any views on the equity side or the bond side in Japan? Is there any opportunity there?
Well, we know that this is a really, really difficult area, and we have plenty of discussions on this with the team. We don't have a particularly strong view on the equity market at the moment, but we are moderately negative on the bond market, which means that we can see yields going up. Inflation is at 2.5%, which might not seem high, but after seeing such low readings for such a long time, it doesn't actually feel so modest. The central bank have tried to keep control on bond yields, but with greater growth in the economy and higher inflation, then those controls might need to be moved or completely removed, and bond yields could then go up.
Okay, so no clear view on equities, but a little bit negative on bonds. Baylee, that's been amazing. In 5 minutes, you've given us almost a full history of Japan since the late 80s. Hopefully, you've given everyone a bit of food for thought, and everyone will have learned something. I certainly did today. We will be back next week with another update. We will, again, put the fund manager on the spot. We'll cover one subject, and we look to do it in around about 5 minutes. Until then, see you next week.